Hello, I'm Kimberley Dondo, Digital Content Manager, and welcome to In Conversation With, the podcast series that delves into the world of financial services and brings you face to face with some of the most notable figures in the industry. Listen as we discuss topics that are currently facing the industry and hear from visionary CEOs to disruptive innovators as we bring you a diverse array of voices and perspectives. We'll explore the challenges they faced, the lessons they've learned, and the insights they have to share about the ever-evolving landscape of financial services. I'm Kimberley Dondo, and in today's episode, I'm joined by Bryn Jones, Head of Fixed Income at Rathbones. Thank you for joining me today, Bryn.
Hi, Kimberley. How are you? Well,
I'm good, thank you. So could you give us a bit of background into yourself and how you got started in the industry?
Oh, crumbs. Yeah. So I've been in fixed income in the city now for coming on 28 years.
Mm-hmm.
I come from a working class background. I went to university. Leaving university, I didn't know whether I wanted to be a semi-professional footballer or work in the city. My brother worked for the Futures Exchange, so I was the big city lights were quite exciting for me. I got a job at Coots to start with, working on a performance measurement team, and then latterly at Fleming's as a fund administrator. And then I went over to, which at the time was Mercury Asset Management, became Bank of America Merrill Lynch, to become a junior portfolio manager in fixed income. Quite liked fixed income at that time. And so I moved into managing money there. And subsequently, just over 20 years ago, I came to Rathbones.
It's probably for the best that you didn't choose the semi-professional football, more job security. Where you are now.
No, you probably see me. It sounds like you've seen me play football as well.
No, I'm not. I wasn't even thinking. I was thinking like my parents. I think just thinking, the job security and the path that you've been able to carve for yourself.
To be fair, you're probably right. So my dad, when I told him that I wanted to play semi-professional football, and I had a job in the city at the same time, he did say to me that, you're probably going to be getting on a coach and going up to Macclesfield in the pouring rain on a Tuesday night in the rain to sit on a bench for the game. And he said, when I was offered the job in the city, he said, you're best off. So I thank my dad, God bless him, for steering me on the right path.
Yeah. Oh yeah. Sometimes parents do know what they're talking about. But because you have such a background and expertise in fixed income, I wanted to ask you first, what's your outlook for fixed income market in 2025? And what factors should financial advisors consider?
Yeah, I mean, let's face it, let's break it down into rates and credit. So on the rate side, bond yields hit new highs, multi-decade highs, driven by inflation fears and possible fiscal worries. In particular, in January of 2025, yields hit a good 20-year high. But that's actually quite an attractive entry point. If you think, fixed income now yielding just in rates, they've rallied a bit, 4.5%, but let's call it 5%, with a bit of credit, pushing 6%. If you can get 7% from your fixed income, that will compound over 10 years to 100% return. So all else being equal, if nothing happens, you're going to get inflation beating returns. And so fixed income's become more of an interesting place to invest in a balanced portfolio. So I'm not saying put all your money in fixed income, but as an insurance policy against potential beta risk. And, let's face it, what's the long-term capital market assumption for equities? 7% maybe, with 4 or 5 times the volatility. So you've really got to believe in the growth story to want to invest fully in equities. So I do feel fixed income has got a place in portfolios. And let's face it as well, after the first interest rate hike in the US in 2022, it takes some time. There's always a lag before you get recessionary and weak economy. So having rates exposure at some point might be quite defensive. And so there's that point. And if rates do come down, then you're going to get a capital gain from your fixed income. So that's a good point. On credit side, we hear a lot of what we bond investors call spreads. This is the extra yield you get over and above a government bond. They look a bit tight. But they can remain quite tight for a long period of time, and the all-in yield is quite attractive. So it doesn't matter that spreads are tight; they can widen a little bit, especially under the 10-year area, and you're still generating a decent return because the extra carry you get and the overall yield gives you a decent positive return. So. Whilst credit spreads remain tight, I think they could remain tight for a long period of time. There's a huge amount of demand for fixed income. There's a lot of money in money market funds. We hear about this, $7.5 trillion in the US and a few trillion in the UK and Europe. If even a portion of that money finds its way into the credit market, it's quite supportive. I do worry a little bit about some of the deeply high yield companies. So if you think about where we are in the credit cycle, if businesses are borrowing at higher levels, and we do enter a period of weak growth, then margins get squeezed quite quickly. So I would just mind your eye, and if you're going to invest in a high yield manager, make sure you pick a really good one. So that's the outlook, really. I think rates are likely to be a little bit lower, so you're going to get some capital gain. You've got a decent all-in yield. Investment grade credit's probably going to do okay. And just mind your eye on some of the more sort of distressed parts of the market.
Right. And with your 20 years at Rathbones, how has fixed income as the landscape evolved, particularly regarding risks and opportunities?
Yeah, I mean, there's always something to do. That's what's exciting about fixed income. It has evolved. When I first joined, or just after joining Rathbones, we went into the financial crisis. Banks had very little solvency. They were run very unregulated. Now banks have got huge amounts of solvency and are regulated very well. So banks aren't what they used to be. They're more utility-like, whereas things like utilities, like water, we don't invest in. And back a few years ago, they looked in a much better position. So you can see how dynamics change across different sectors over time. There's a danger that Trump administration deregulates the US banks further. European and UK banks would have to deregulate as well to compete, and that's a danger we don't really want to push banks back to sort of the solvency levels that we saw during 2008. There's been a huge amount of regulatory change within the banking sector, within the capital structures, additional tier 1 and old legacy bonds, which we've played really aggressively in the ethical bond fund and the strap bond fund, where these bonds can no longer be kept outstanding. So there's always something to do. There's changes that happen, dynamics, fiscal policy changes, all these things over time provide volatility, and with that volatility comes both opportunities and risks.
With market volatility a reoccurring concern, what strategies can advisors use to keep clients focused on long-term goals? Some people see it and then they freak out and they want to sell. But what strategies could advisors use to have their clients have that long-term look?
Well, I think there's two mantras that I follow a lot, and these weren't mine. These come from far more intelligent investors than me. And one of them is like, be greedy when everyone's fearful, and be fearful when everyone's greedy. I mean, these are classic things that we've done. During just before COVID, spreads were very tight. Everyone was being greedy. We were getting quite fearful. In COVID itself, everyone was fearful. We got a little bit greedy. We was out buying risk at really cheap levels. Post Credit Suisse, we didn't hold any Credit Suisse. We didn't like the company. But on the Monday after, when everyone was worrying, we were out buying stuff that we'd done a lot of work on. So again, advisors, don't just look at momentum. Sometimes it's to look at the longer picture. I think with advisors as well, it's obviously the client is quite important, their investment horizon, their tax. There's loads of other elements that they need to focus on. But I think in a bond perspective, it's like, go and find a good manager that you trust, that you understand what they do. They'll lift the hood. You can have a look underneath. You can see what they're doing. They don't chop and change. If we look at the ethical bond fund, we're very honest. It's a higher beta play, and we like going and find truffles, and that's what we try and achieve. So get to understand your manager, make sure that they stick to their guns. If they're going to change, that they're communicative about it. But also, this kind of buy low, sell high is a really important ethos. These are just investing mantras, but also don't just chase value. Like within our fund, we won't buy something just because it's cheap. It has to be a good quality business. And I will say this as well: do find a good active manager in the bond space. Now, whilst I can't talk about equities, there's clear evidence that if you look at the UK corporate bond sector, for example, the sector has outperformed passives over every single period. And so whilst we've massively outperformed the sector, and I think over 10 years outperformed our nearest passive by nearly double. So if we stand still and we have another same 10 years, it will take them 10 years to get that same kind of return back. So in the bond space, I would say go and find a good active manager, whether it's us or somebody else. Really focus on that, because the passives aren't delivering in the bond space.
Right. And how does your investment approach shape your fixed income decisions, and why should advisors care about it?
Yeah, well, we've got long-term outperformance. I've been at the firm 20 years, top decile performance, top quartile performance over most periods. We're long-term investors, we're active, we do high conviction. Our process is not just going to buy cheap stuff. We've got this Venn diagram that anyone can look at. It's valuation, it's the quality of the business and the credit quality of the business. It's the risks that we're taking. And it's the theme. We're looking at great themes out there. What are the themes of tomorrow, and what were the themes of yesterday? Let's avoid the things that are going to do. I mean, just take a classic example. Not that we can buy booze for our fund because it's an ethical fund, but we could buy it for other funds. But if you take January, for example, it was it's the driest January for alcohol companies in 4 years. So these are these themes you just need to follow, and it's those themes, good quality businesses that are cheap, that provide the right level of risk to your portfolio, and in particular, if you've got a sustainable or an ethical fund, that provides a nice little kind of cushion for you as a sustainable investor on a long-term basis.
And how does biodiversity loss impact investment strategy? And what role do fixed income products play in environmental resilience?
Yeah, I mean, they can do. I mean, companies now have to report a lot of what they do in terms of their carbon impact. We have a net zero ambition for the fund. We have a certain percentage of our funds that are either following science-based targets and of either that or a net zero target. But we're actually actively going out and looking for more impactful investment. So we have this whole thesis about the Anthropocene. And it's one of the themes that we've been following for a number of years, about the humans having a bigger impact on the environment having on them. And so this part of the Anthropocene is biodiversity, it's the climate, so we're looking for investments that are going to improve that. That's the ultimate goal for, not only, operational alignment, which we're looking for activity alignment as well, both from our sustainable bond fund and the ethical bond fund. And the Anthropocene is important to us because, if we destroy biodiversity, it's such an important part of the planet. We don't really fully understand, for example, within the sea, there's this layer which basically just convert a lot of the carbon out of the atmosphere. It creates a carbon sink and drops to the bottom of the sea. We don't fully understand that. And I think it's important to maintain that biodiversity. So we've got a number of investments in the fund, like Nature Conservancy, which is a not-for-profit business in the US. Things like the Canals and Rivers Trust, which is trying to look after the canals and rivers in the UK. And an Amazon reforestation bond where we're looking to, we've invested with the World Bank, who basically lend money to a business called Mombac. That business buys up land in Brazil, and that land gets converted to forest, and those carbon credits get sold onto Microsoft. So it's a very secure holding that looks after the environment. So you can see how we're looking for more impactful ideas, as well as just saying, well, this business is operationally aligned.
And I don't know if we discussed this earlier, or if you mentioned this earlier, but I think you have a background in geography. So how does that influence your approach to market trends and sustainability in finance? Does it?
Well, yeah, I mean, it does. I mean, it's interesting. There are two sides to geography, human geography, and which is why people do things, and it really does. Geography gives you a broad understanding of the world. But also you've got the physical geography element. So that's more on, what impacts does it have on environments and areas. So arguably, I do think geography has given me a broad spectrum. When you do geography, you learn economics, you learn you learn psychology, you learn about the environment, you learn about the world. And when I'm looking out the window now, I'm currently sitting out, in the office in the city, and I'm looking out the window, I can see the whole world out there. And I try to understand, if I'm looking at the world, what impact is that going to have on my investment? And similarly, what impact is my investment going to have on the world? Is it is it fiscal policy? Is it the environment? Is it culture? What the impacts of this? Are people going to give up smoking? And all this kind of behavioural stuff is quite important. So I do think it brings a decent perspective to invest in. It gives you a broad knowledge of the world, and I think that's important with anything.
Yeah, definitely. I think everyone's background can all kind of feed into their profession. Any little skill that you pick up, it all comes together.
Yeah, and when we talk about a team as well, right? So each of the team have got different degrees. We've got people with maths degrees, economics degrees, and geography degree, and all that team-based approach is important. We all look at the world slightly differently, and we all bring different challenge. And I do believe, and I've said this before, I think the team are like a shoulder fish. We all tend to follow each other. And, if someone throws a stone in the water, we might go off in different directions to find our way back to the path again. And so as a team-based thing, it's not just myself, and that's important. I've always said that, I feel like I'm a front man. I'm just I'm singing the songs, right? Everyone else is writing the music and doing the production in the background.
And it all comes together beautifully.
Hopefully.
Yeah. So what are the most common questions advisors ask about fixed income, and how do you address their needs in today's market?
Well, I think the big topic, they change from time to time, but the big topic now is obviously 2022 was a pretty tough market for fixed income. We had the fastest rise in interest rates. Jim Reed at Deutsche Bank is quoted as saying it was, the fastest rise in interest rates since 2 years after the US independence. Rates did move up pretty rapidly, and people saw mark-to-market losses from their sort of defensive part of their portfolio. and I guess that's what people worry about. Are we going to have that again? But also people worry about the correlation with equities that we've seen in fixed income as well. So when yields rise, stocks do badly, and then when yields fall, prices go up in the bonds, but so do they do in the equity. I think people are, advisors are thinking, well, if that's going to happen, why not just buy a load of stocks? Which you can see that, but that's okay until it's not, right? And something happens, stock market falls 20, 15, 30%, your bonds are going to be up 20%. So I just feel that that's the biggest question at the moment, and advisors are finding that quite tough. They're saying, well, I want to allocate to fixed income because it looks cheap, but what can you tell me that makes sure that you give me the confidence we're not going to have another 2022?
Yeah. And finally, what changes have you seen in sustainable bond offerings, and how can advisors position them effectively for clients interested in impact investing?
Well, look, sustainable bonds, UN Sustainable Development Goals didn't exist when I joined this firm, and we had an ethical bond fund. So we got negative and positive screen. That's important. Then we started getting green issuance, sustainable issuance. There's been blue issuance as well, as in like ones that look after the sea. And I think the main thing is that if you're going to have a look at these in a direct basis, you just have to be careful that the use of proceeds are correct. There's third-party verification. A lot of them are bringing that. The market's huge now. We're talking trillions in size. So there's a huge amount of supply out there. In terms of bond funds, in a sustainable space, well, again, make sure that they have really strong process. And of course, the regulators in Europe have got SFDR, and so you've got Article 8, Article 9. The ethical bond fund LuxSICAV is Article 8, so that can deliver sustainable returns based on the regulatory requirements. In the UK, the ethical bond fund is down the naming and convention area. So we've got the new SDR regulations that have proved a little bit onerous for some businesses, and a lot of businesses have been removing the word sustainable from their name. Others have been getting SDR label. We're in the throes of all that at the moment. Coming into April for our sustainable bond fund. But yes, there's a lot of offerings out there. Again, like anything, do your due diligence, lift the bonnet, go and meet the manager, find out what they're doing, and if you're comfortable with it, then then you should be looking to buy.
Okay. Well, thank you for speaking with me today, Bryn. This was a really enlightening conversation.
Excellent, great. And you won't see me donning a football shirt and a pair of football boots, although I do coach an under-14s football team, so perhaps I can impart some of my knowledge on the youth of the world.
Yeah, exactly. I think that's always a good thing, to still use that talent that you have, and I don't know, you get to live all your dreams.
Cool. Thanks, Kimberley.
Thank you for listening to In Conversation With. We do hope that you enjoyed it. Please do keep up to date with all our new releases via Podbean, Apple Podcasts, Spotify, and everywhere else you get your podcasts from. You can also keep up to date with all our new content published on the Money Marketing website, as well as our print edition Money Marketing magazine, so make sure to subscribe. Follow us on Twitter, LinkedIn, Facebook, and Instagram. See you next time.